From the University of Westminster, this is The Week Ahead with Dave Coker.
All right, guys, let's get started. This is Sunday, September 27th. My name's Dave Coker. This is, of course, The Week Ahead. Let's take a look and see what key events are happening, and we'll look at a couple other high-level indicators before we start to look at each day. So the post-crash reflation trades on the agenda for this week. We've seen some very sharp weakness in U.S. markets over the past 2 trading weeks. Not totally sure what's going on. It seems a lot of people, and I've got a presentation or a slide about 3, and I'll show you. It seems a lot of people are losing taste for equities. A lot of money's been made this year. We're approaching a very, very volatile period of the year historically. Autumn is never really too kind to the markets. There's usually some volatility historically in the U.S. markets. And we've got a presidential election coming up, which is, boy, it's going to be messy. So watch that. We're pay attention to the post-crash reflation trade. See if markets continue to go up. I'm sort of dubious myself. We've got on Tuesday night the first 2020 debate for U.S. presidential candidates. Now, this is Mr. Trump and Mr. Biden, the right and the left, respectively. And it'll be very fascinating to see what happens. Biden allegedly, in terms of polling, is in the lead. Of course, we saw that play out the same way in 2016. Clinton was so far ahead that the New York Times actually said she had a 95% chance of winning the night before the election. And she really did poorly compared to Mr. Trump, who really skillfully ran a tactically very, very well-planned campaign. Can they repeat it this year? Not really sure, but it all starts with the debates. Watch them. Mr. Biden is, of course, accused of having dementia and all sorts of mental issues. Mr. Trump is not even accused. It's pretty clear that he's sort of a jerk. So we're not totally sure how this is going to go. It's going to be explosive. So that's Tuesday night. Unfortunately, it comes on at 9 p.m. Eastern Standard Time. That's 2 a.m. our time. I wouldn't recommend staying up for it, but definitely the next morning, definitely take a look at it and see what happened. U.S. dollars is freakishly strong, and this is something that's caught a lot of market participants unawares. It's really wild what's going on here, because even as the U.S. continues to debase the currency by printing trillions of dollars, and the economy is performing very poorly, as we'll see when we start to look at some of the data coming up, the U.S. dollar is just getting stronger and stronger. Now, really what's going on, guys, keep in mind FX is a zero-sum game. So actually what's happening is the dollar is holding its own, maybe getting a little stronger, but other currencies are collapsing. So it's not so much the dollar strength. The media's got that wrong. It's more or less the weakness of the other G7 and perhaps G20 currencies. On Thursday, there's an EU leaders summit. Sparks may fly. We'll have to see what happens. Brexit's one of the key topics, and that will have a lot to do with the settlement that the UK hopes to negotiate with the EU by the end of the year, as well as exiting the EU with or without a deal. I mean, we're already out of the EU, but will there or will there not be a deal coming into 2021? And of course, we can't escape it. COVID, it's with us. Very fascinating when you start to look at what's going on in the UK, for instance, with lockdowns and curfews, and compare it to what's going on in other European nations. Yeah, the hit to GDP has been severe. And we're not really sure how much longer they can continue to pay out, or really what's going to happen. It really is a dominant story. I should have put it at the top, but I put it at the top last week, and I want to get your minds off it a little bit and focus on other market events. Now, last week we looked at the S&P 500 performance over the past year. Now we're going to look at it for 1 month, and my gosh, what a month it's been. We all talk about tech. Everyone mentions about how strong tech is. Well, look at this. Over the past month, not so much. If you're inclined to buy, yeah, there's some weakness there. You might want to go in, whether it's short-term or long-term, who knows? And guys, I've been upfront with you in terms of the way I invest. I only buy for dividends, so I'm not interested in any of this garbage. I've got my own list, right, of stocks that pay me dividends. And why would I buy one of these stocks like Amazon or Facebook or Google or Apple? Why would I buy it when I can't get a dividend? Some of the stocks I own pay dividends of approaching 20%, in some cases over 20%. So in other words, I get paid in every month for holding stocks. These returns are pretty poor. We're going to look at the forward price to earnings ratio. Remember last week we looked at the price to earnings ratio. That was what's called trailing 12 months or TTM. Now we're taking current period earnings or forecast earnings, and we're calculating the forward price to earnings ratio. And again, you see these absurd valuations. Amazon, for instance, trading at 70 times forward earnings. Facebook, 25 times. Now, the thing is, guys, when you and keep in mind, the long run in the States, the long run PE across the entire stock market is roughly 17, maybe 15. Depends whose data you use and what time they look at. So you're talking roughly 17. When you're buying a stock like Amazon that's trading at 70 times forward earnings, what you're doing is you're effectively placing a bet. You're effectively hoping that their earnings will continue to grow at an accelerated rate that would therefore the stock price will rise and it will justify your purchase. Good luck. I'd rather sit back and collect dividends. Now, the weakness in the market, this is in my chart. I've got that from a colleague. It's very fascinating when you start to see the S&P 500 and the damage that's been done over the past 2 weeks or so. What's going on? Well, it looks like big entities are pulling out. So they're no longer taking positions in futures. They're no longer speculating. Where are they going? Who knows? These people really don't talk about what they're up to. You can find it. You can find out what the hedge funds are doing after the fact. But a coincidental? No, they're not going to tell you now what they're doing. You can read it later on through regulatory filings, or they may even talk about it. So that's very fascinating, and that's where a lot of the weakness is coming from. Smart money, I hate to use that phrase, but we'll use it. The smart money is actually pulling out of the markets, the futures market, and it's not really a good sign for U.S. equities going forward. Oh, my animation. Oh, my God. I'll just put these all up for you. Boy, I really messed that one up, didn't I? All right, guys. Monday, September 28th, Dallas Fed Manufacturing Index for September. The previous was a dismal 8. Forecast, nobody really knows. Pay attention to it because this gives us an idea about manufacturing performance in the United States. Mester speaking, FOMC member. Remember, guys, as I talked to you about this last weekend, you want to know what the Fed is going to do before they do it. That's how you make money in the markets. You anticipate movements of the Fed. How do you anticipate movements? You listen to each and every FOMC member's statements. When they speak, you listen. You'll know what that Fed's going to do, or you'll have a better idea of what that Fed's going to do in 6 weeks' time when they meet to set interest rates or to set monetary policy again. So that's 2 o'clock, and I really oh, and this time my timing was intentional. I wanted to put the chart at the bottom. So at 11:30 a.m., we got 3-month and 6-month T-bill auctions. Previous were 0.11 and 0.105. Again, you can get a feeling for how low interest rates are in the States. There's actually no real return. Remember, real returns are inflation adjusted. And when you see something like for 3-month money, 0.11, you subtract inflation from it, bam, you got a negative return. And we are in the land of negative real interest rates in the States. On Tuesday, September 29th at 8:30, we got retail inventories ex auto for August. Prior was 0.6% expansion. Admin didn't give us a forecast. I'm not sure what's going on there. So once again, watch that as inventories grow. They're growing because demand typically is falling. At 08:30, we also have wholesale inventories coming in month on month. Prior was a 0.2% contraction. Don't have a forecast there, but again, this will give us an idea of what's going on the wholesale side. So we got inventories at 2 stages, wholesale and retail. Retail, of course, is customer facing, and wholesale, of course, is what the stores keep on hand. And then we got a spate of FOMC members speaking. My gosh, from 9:15 to 13:30, 4 of them. So Williams, Harker, Quarles, and Williams once again. So once again, guys, try to pick up at least one of these, and you'll have a good idea of what the Fed is going to do because you'll be hearing their commentary in real time. If you can't do it, if you can't watch it, that's fine. Just Google for it, and you'll be able to get the statement. And a lot of times I prefer to read it after the fact because they might take 90 minutes to blag their way through something with all the questions. You're better off just reading it. Wednesday, September 30th. At 0700, we got MBA, the Mortgage Bankers Association, 30-year fixed rate mortgage. Prior was 3.10. It's actually forecast to come down a little. I did put that in. I don't know what happened to it. So it's come down by 1 basis point. So it's 3.09. I mentioned this last week, guys. One thing that's very cool about the U.S. when you buy a property, you can lock in that rate for 30 years. So you know exactly what your mortgage payments are going to be for the next 30 years. Absolutely incredible. And tactically, it has you behave a little bit differently than you would in the UK. In the UK, you can get a commitment of funds for 30 years, but they're not going to talk about repayment terms for anything more than 7 years, maybe 10 at the outside, right? In other words, at the end of 7 years or 10 years or 2 years even, you have to renegotiate payment terms. And generally, it's not a problem, but for me, putting my risk manager hat on, it's a risk, it's an exposure. You have no idea what's going to happen to interest rates when you come back to renegotiate. At 0700, oh yeah, and getting back to that. So in the States, the philosophy is to buy the biggest house you can early on because you're starting your career, you're just becoming established, and over time your earnings will grow. So a painful mortgage payment now will be something you'll just slough off in 30 years when presumably you've risen up the corporate ladder and are making much more money. In the UK, you got to play it tactically, a little bit different. Personally, I don't like debt. I tend to pay cash for properties. But if you can't do that, you're advised to put down as much as you can in terms of deposit. And then you're advised to pay it off as quickly as you can. At 0700, MBA, Mortgage Bankers Association applications. Prior was, excuse me, sorry. Prior was 6.8%. Forecast, we don't have something. Admin didn't give us that. At 0830, we got core PCE. This is the personal consumption expenditure, and this is basically a metric that helps us understand inflation. Prior was a 1% contraction in prices of goods and services. Forecast to come in at 1% contraction again. Yes, this is called deflation, and it's happening in the United States right now. Media doesn't talk about it too much. They should. In fact, not at all. They should. It's definitely a concern. At 0830, we got US GDP for quarter two. We're going to be looking quarter on quarter. The prior was a 31.7% contraction in GDP. We're forecast to come in at 31.7%. So it's pretty bad out there. And guys, putting these two together, it corroborates my oft expressed view that the United States is effectively in a depression at this point. Media hasn't been calling it that, but from my point of view, it's a depression. And I've been planning for a depression for quite a while, actually, for well over a year. I was getting very nervous with the state of equities in the markets. So as I told you guys, I sold a whole bunch of stocks and moved all that money into gold and silver. So about over 50% of my retirement money right now is parked in gold and silver. And I've been building cash up for a while. Not so much that I thought a depression was coming, more that the markets were just too crazy, going up far too fast and far too high. And I was getting very nervous, so I just really cut back expenditures. Not that I spend much money anyways, I'm pretty cheap. And lockdown makes it really good for not spending money. But yeah, I built up a lot of cash, so I do think we're in a depression. That's just my view. Thursday, October 1st, again, you can see my awesome animation there. All right, at 0730, we got something called Challenger job cuts. We're looking at two different things. Now, I like these metrics. Again, it's okay to look at the government data that comes out from BLS, the Bureau of Labor Statistics, but you want to look at third-party data. Sometimes third-party private economic data disagrees with the government, and we do learn more when we look at private data because it's measured a little bit differently than what the BLS does. So here we got job cuts. In the prior reading year on year, we had a 116% increase. We don't have a forecast, but it doesn't look super good. And then in September, the prior was 115,000 job cuts. Forecast, we don't have one, but it's going to be roughly the same, I think. We'll have to see what happens there. At 0830, we got 4-week and 8-week T-bill auctions. So we're talking about 1 month and 2 month T-bills. And again, you can see overall how low interest rates are. And you see we're effectively at zero for all intents and purposes. It's pretty amazing what's going on there. And I've got a 1-year chart here so you can see what's been going on over the past year. And Friday, come on, I know there's one there. There we go, perfect, yeah. On Friday, October 2nd, at 0830, we got average hourly earnings. We've got year on year for the month of September. Prior was a 4.7 pop up. Forecast is 4.8% increase. Now, this is a little deceptive, guys, because what happens is all you need is a few at the extreme. This is the problem with averages. And we've seen some extremely huge increases in average hourly earnings for large parts or for certain parts of the labor force. It's really interesting. So they distort it, and really should be looking at median, but they don't do it. So we've got it for the average hourly earnings for year on year, and we've also got September only. And September, we're seeing a 34.6% the weekly hours rather, I should say, 34.6, forecast to come in at 34.6. They're not increasing the work week, the working hours at all. And that means the economy is still relatively weak. At 0830, manufacturing payrolls, prior was 29, forecast 35, modest expansion in manufacturing payrolls there. And finally at 0830, got the labor force participation rate for September. Now, guys, I wish I could tell you this is an anomaly and most Americans work. No, that's not true at all. It's always been below 70 for the past 10 years, I believe. It's been really, really bad. If you think about it, yes, but this is saying exactly what you're thinking. Only 61.7% of those eligible to work actually are working. It's distorted somewhat because in spite of what the state says about being squeaky clean, we know the underground economy is very strong in America. And we know that a lot of these people that could be working, the missing component there, the people that could be working actually are working, but they're working in the black economy, the underground economy, the cash economy. It's very, very large in the States, as it is in many of the G7 or G20 nations. Some people find it, they'd rather work and not pay taxes. And what a surprise. Very often they catch some of these people and, oh my God, they're on benefits too. Yeah, the morals of some people. But pay attention to the participation rate, guys. It is likely to get worse because the jobs just aren't there. All right, guys, it's been the week ahead for September 27th. I hope you have a very profitable week. Take care.